I am Jason Fox of John Scott Real Estate, and this is the Seattle Housing Market Report for November of 2022. All right, would you be shocked if I told you that the average sales price for a residential resale home in Seattle, Washington is actually increased over the last 2 months? Yeah, so was I. But let's take a look at what is causing that. You're probably thinking, but Jason, I'm seeing the reports. The home sales are down, the interest rates are up. And yes, both those things are true. And while that does suck for me, the real estate agent, for home sellers and even home buyers, which I'll discuss here in a minute, it's not that bad. Why are home prices actually able to increase when it feels like everything is going down? Well, the biggest factor is inventory. But let's take a look at the three key indicators that determine the health of the Seattle housing market. All right, the first key indicator we want to take a look at is the sales activity intensity. And that is the percentage of new listings that come onto the market that go into a pending status, or means they go into contract within the first 30 days of hitting the market. That's a really good indicator of how things are moving along. So we're at 44.5% of new listings go pending in the first 30 days right now. So if we look at the scale that's down below, we can see that's a strong market. And we're at 45%. We're actually at a very strong market. So we're bordering on strong to very strong. So that's a good thing. The second indicator we want to take a look at is the inventory level. And so the inventory level right now, it's at 2.2 months supply in Seattle. And that's considered low. And at 2 months or below, that's considered a shortage. So we're right on that shortage to low side. And so while there are a lot more listings, and as a matter of fact, than there's about 8 times more listings than what we had gotten used to over the last couple of years. But as I keep saying in these reports, what we got used to over the last couple of years is outside of the scope of normalcy. That was sort of a once in a lifetime thing. So now we're back to, what are actual numbers based on, all the years of data. And so we're at a low to shortage supply of inventory. So when obviously it's a supply and demand thing, as you don't have as much inventory out there, then when buyers do come along, there's more demand on it. So homes are selling pretty quickly because there's not a whole lot of supply out there. Now, the third key indicator is the interest rates, which this is well documented and everybody is really aware of what's going on there. As of the time of this report, we were at 7.09%. But this morning, it looks like we took a big dip down. So that's good news. As we learned in our John Scott convention this year, as we listened to the National Association of Realtors economist, Dr. Lawrence Yun, there is a resistance point with the interest rates at 7% and then again at 10%. So right now, if we're hold tight at the 7%, high sixes, low sevens, that's a good thing. We might hold there for a while, but if we do break through that, we might keep going until 10. So 7% is not so bad. Now, the big deal is that if we can get those aforementioned seller credits, then oftentimes what we can do is we can use those to buy down your interest rate, both permanently and temporarily. And I'm not talking about an ARM mortgage per se, although speak to your lender, that might be a good option for you. I'm talking about 2-1 buy downs and permanent buy downs, where we can just literally get the seller to fund us getting a lower interest rate to help meet our debt to income ratio. And then as we sit on a good investment that is hedging against the inflation that we're seeing right now, we can wait until those interest rates come back down and then refinance, and we're in really great shape.